Maker price has gone up over 75% in a week, despite the recent volatility in the crypto market as a whole. A huge $156 million worth of DeFi tokens were burned not long ago, which seems to have caused the price to rise. So people who follow the market are very optimistic about the token's future, though a recent smart whale trade move has led to different ideas. A transaction tracker called Whale Alert said in a series of posts on February 20th that a huge $156.77 million Maker token was burned lately. This severely reduced the number of tokens in circulation. As a result, the weekly picture shows that the Maker price went up 77%. This is because supply and demand work that way. To give you some background, token burn mechanisms work to forever lower the number of cryptos on the market, which drives up their price. Meanwhile, the wallet address 0xF65 was reported to be solely responsible for the massive burn, per Whale Alert data that showed 8 colossal burn transactions on February 20th. Market watchers weigh substantial optimism over the asset in light of the supply shredding drastically within such a brief time. At the same time, another important reason seems to be behind the recent growth of the leading DeFi token. As per DeFi Llama statistics, the TVL on the Maker ecosystem stood at $5.55 billion on Friday. This data further confirmed the protocol's market standing, making it one of the top DeFi projects on the Ethereum blockchain. As was already said, the price of Maker coin has already gone up 77% in a week and over 22% in a day, despite the general market chaos. The coin currently rests at $1,445, with an hourly low and high of $1,177 and $1,473. Traders also appear to be positive amid the massive burn, as the coin's intraday trade volume soared 166% to $257.95 million. One of the largest decentralized applications, dApps, on the Ethereum blockchain, the Maker protocol was designed by a disparate group of developers and is governed by the MakerDAO. The MakerDAO is a decentralized autonomous organization, DAO, made entirely of MKR holders from around the world. These MKR holders are able to stake their MKR tokens in order to vote on proposed changes to the Maker protocol, as well as ensure the efficiency, transparency, and stability of DAI. For all of its vast differences, holding MKR is somewhat similar to owning stock in a traditional company, in the sense that the shareholders have a say in determining how the company functions. The Maker ecosystem was one of the first DeFi projects to achieve significant success, or a testament to the effectiveness of truly decentralized governance. What is DAI? DAI, or DAI, is a decentralized, unbiased, collateralized stablecoin soft peg to the US dollar. This may sound complicated, but in essence what it means is that it's a cryptocurrency whose price roughly follows the value of the dollar, without the need of a central authority. While blockchain technology presents exciting new opportunities for the finance industry, many are reluctant to use Bitcoin as a medium of exchange because of its incredibly volatile nature. This is why DAI was created, to meet the demand for a more stable digital currency that enables us to realize the full potential of blockchain technology. DAI is unbiased because it isn't managed by a private company, like other stablecoins such as USDT, and it's collateralized because new DAI can only be minted by a Maker protocol user who deposits an appropriate amount of other cryptocurrencies into a smart contract in order to back the new DAI being minted. DAI holders can also use the Maker protocol to earn interest on their stablecoins, with the amount being determined by the DAI savings rate. How does Maker work? The Maker protocol generates new DAI through smart contracts known as Maker vaults. These contracts can be created through various web UIs and apps that essentially act as portals to access the network through, such as Oasis Borrow or InstantApp. When a user wants to retrieve their collateralized crypto from the smart contract, they must first pay back the DAI they generated along with a stability fee. The MKR token can also be used to govern the Maker protocol. Proposals to be voted on take the form of a smart contract and can be deployed by any Ethereum address. The MKR holders community can then vote on which proposal they would like to pass, and the Ethereum address which receives more approval votes in the form of MKR is granted administrative access to make the proposed change to the Maker protocol. What are smart contracts? First coined in the 1990s by computer scientist Nick Szabo, they are types of computer code which digitally facilitates a business deal or other agreement between two or more parties by automatically executing when the pre-agreed conditions are met. As the code is stored on a blockchain, they are immutable and distributed, meaning that they can't be tampered with and their output is validated by everyone on the network. Who are the founders of Maker? History of Maker. The history of the Maker ecosystem went through various stages, the first of which was the MakerDAO. This was created in 2014 by Rune Christensen, a Danish entrepreneur and graduate of the University of Copenhagen. After studying international business and biochemistry, Christensen co-founded the recruitment company TriChina before moving into blockchain. DAI was officially launched on the Ethereum network in 2017, followed the next year by the formation of the Maker Foundation, an organization which aims to fuel growth of the ecosystem and is spearheading efforts to decentralize development. Christensen serves as CEO of the foundation, while others on the board include President and CEO Stephen Becker, who previously founded Cubic Capital, and economist Shefali Roy. Initially, Ethereum was the only asset that could be collateralized through Maker protocol, with the DAI generated being known as Single Collateral Dai or SCI. In 2019, the MCD system was implemented, so today, any type of Ethereum-based asset that has been approved by the community of MKR holders can be deposited. What makes Maker unique? Maker offers its community of MKR holders the unique opportunity to directly participate in the governing of DAI, one of the most popular stablecoins on the market. They can use their MKR tokens to vote on the following types of proposals. Asterisk which new cryptocurrencies to add as collateralized assets to mint more DAI. Asterisk altering the risk parameters of those cryptocurrencies. Asterisk making changes to the DAI savings rate. Asterisk choosing the oracles. These are tools which supply real-time data on market prices to the Maker ecosystem. Asterisk upgrading the system. The voting power of each user depends on the size of their MKR stake. Risk parameters. Once an Ethereum-based crypto token has been approved as collateral for the Maker vaults, the community must decide on specific parameters for its risk. These are determined by the asset's risk profile and incorporate the following. Asterisk debt ceiling. The maximum amount of debt that can be created by particular types of cryptocurrency assets. Once this value is reached, no more DAI can be minted by that vault until some or all of the debt has been repaid. Asterisk stability fee, a fee that must be paid in DAI in order to retrieve collateral from the smart contract. It is an annual percentage yield calculated on top of how much DAI has been generated. Asterisk liquidation ratio. This value reflects how much market price volatility the MakerDAO expects of the cryptocurrency asset. Asterisk liquidation penalty, a fee added to the value of a vault's debt if liquidation occurs. If a vault is deemed too risky based on these parameters, it is liquidated through automated auctions.